In this video, we're going to discuss 5 important changes that have just been announced with Social Security. These changes could impact you personally. Coming up next on Holy Schmidt.
Holy Schmidt!
In 2025, and in most years, there are many changes that happen to Social Security. Most of those are largely invisible. You don't see them. But there are 5 that are supremely important, and they could affect you personally, and that's what we're going to cover off next. All right, let's go. Let's dive into the first point, the cost of living adjustment, or COLA. That will increase by 2.5% in 2025. For example, if you received $20,000 in Social Security payments in 2024, that amount will go up to $20,500 next year. Now, some of you are saying, so what? Last year it was 3.2% and it's come down. Why is this an important change for me? This is a fair comment. More is usually better when it comes to your own money, but think about what's happening in the background. A large increase in the cost of living adjustment means that the cost of living has gone up fairly significantly. And most people have more than just their Social Security payment that they use to finance their lives. Sometimes you have savings, sometimes you have a 401k or a pension that may or may not be indexed to inflation, and sometimes you might just have an inheritance. But whatever the case may be, it's not a perfect match. When the COLA, or the cost of living, goes up, some of those other elements may or may not go up. And also the Consumer Price Index, the underlying indicator that really drives the cost of living adjustment, isn't perfect either. For example, a lot of the subcategories are much higher or lower than the current COLA increase. For example, anything home-related last year had a tendency to be a little bit higher than the number. For example, the cost of fuel to fuel your home, or the cost of electricity anyway. Rents went up more in general than the cost of living adjustment. The second is that CPI is based on replacement cost, not the change in price. So for example, if you bought a pair of chinos last year at Brooks Brothers for $83, and this year you just couldn't afford it, so you went to Old Navy and you bought a pair of chinos for $27, the difference, which is a 67% decrease in cost, represents your change in consumption pattern, and it actually drives the CPI number down, which means that your COLA number goes down, irrespective of the fact that you had to switch from a branded to a non-branded product to get there. Next, let's discuss the wage cap. The wage cap is the maximum amount that you earn that Social Security can be taxed upon. For example, if you had a $100,000 income, you and your employer would each pay 6.2% into Social Security. So you'd pay $6,200 and your employer would pay $6,200. To illustrate, if you earn $100,000, the total combined contribution is $12,400. However, there is a cap at which you and your employer stop contributing to Social Security. For 2024, that cap was $168,600, and in 2025, it's gone up to $176,100. Earnings above this amount are not taxed for Social Security. This means that if you're an ultra-high earner, say someone who earns $200,000, you'll pay the full 6.2% on the first $176,100. That's $10,918.20. You and your employer won't pay Social Security tax on the remaining $23,900. Of course, if you earn less than the wage cap this year and you earn less than the wage cap next year, the wage cap doesn't really apply because you're paying the full 6.2% on everything that you earn. Next, let's discuss bend points. I call these the great equalizer. Bend points uses your best 35 years of earnings indexed into today's dollars and averages the monthly amount that you earned during those 35 years. That average indexed monthly earnings, again indexed to today's dollars, is fed into a formula using bend points, and your payment, your Social Security payment at full retirement age, comes out the other end. Let me explain how it works. If 2025 is the year you reach full retirement age and you file for Social Security that year, the SSA will give you 90% of the first $1,226 of your average indexed monthly earnings, 32% of amounts between $1,226 and $7,391, and 15% of any amount above that up to the wage cap we just talked about. For reference, in 2024, the SSA gave 90% of the first $1,174 of your average index monthly earnings, 32% between $1,174 and $7,078, and 15% of any amount above that, up to the wage cap. So it's gone up 4.4% year over year. Let's use a real example. If you earned an average of $24,000 per year over the last 35 years after we index the historical amounts to today's dollars, then your average indexed monthly earnings would be $2,000 per month. That's just $24,000 divided by 12. If you're at full retirement age and file for Social Security, you'll receive 90% of the first $1,226 and 32% of any amount between $1,226 and $7,391 per month. If this was the case, you'd receive $1,226 times 0.9, which equals $1,103.40 per month, plus the difference between $2,000 and $1,226 times 0.32, which equals $247.68 per month. So the grand total of your payment, if you filed for Social Security at full retirement age, is $1,351.08. Just for completeness, so you can see how this works at the high end, here's an example using a much higher income number. If instead you earned an average of $240,000 per year over the last 35 years, indexed to today's dollars, that translates to $20,000 per month. You'd receive 90% of the first $1,226, which is $1,103.40, just like before, plus 32% of the difference between $73.91 and $1,226, which is $1,972.80. And 15% of the difference between the wage cap on a monthly basis and $73.91. The difference, $176,100 divided by 12, equals $14,675 per month, minus $73.91. That's $72.84. That's the difference between the wage cap on a monthly basis and the second bin point. $72.84 times 15% is $1092.60. The total Social Security payment at full retirement age is $4168.80. But you wouldn't receive Social Security on anything above the wage cap because you didn't pay any Social Security tax on anything above the wage cap. While both the $24,000 earner and the $240,000 earner each contributed 6.2%, at least up to the wage cap, the smaller earner, the $24,000 earner, receives a much higher percentage payout of their Social Security tax paid in. Most people think this is fair, of course, because the system is designed to protect those most in need, and the individual who earned $24,000 per year is more than likely in much worse financial shape than the individual who made $240,000 per year. Next, let's discuss the earnings limit, which is the maximum you can earn while still collecting Social Security without having to give part of your payment back. The limit has increased from $22,320 to $23,400 per year for anyone who is not yet in their full retirement age year. Full retirement age, by the way, varies between 66 and 67 depending on your birth year. If you are under full retirement age in 2025, you can earn up to $23,400 without losing any of your Social Security benefits. For every $2 over that limit, you must return $1 to the SSA. If this is the year you reach full retirement age, but you haven't had your birthday yet, you can earn up to $62,160 in 2025 without losing benefits. For every $3 you earn above that limit, you have to return $1 to the SSA. It's important to note that once you reach full retirement age, you don't have to give any of your Social Security payment back to the SSA. No matter how much you earn, you can earn $1 billion a year and it doesn't matter. Also, at full retirement age, any amounts that you gave back to the SSA are given back to you in the form of a higher payment going forward. It's also important to note that most people don't decide to retire on January 1st, and the SSA knows this. So they have a rule that says in the year that you draw Social Security, anything that you earned prior to filing for Social Security doesn't count. But those limits are broken down to a monthly basis and tested on a monthly basis in your first year only. Next, let's talk about work credits, which are necessary to qualify for Social Security. You need 40 work credits, 40 quarterly work credits, or roughly 10 years of work to qualify. In 2025, you must earn a minimum of $1,810 per quarter to receive a work credit. You can earn up to 4 credits in 1 year, but no more than that, regardless of your earnings. For example, if you earned $7,240 or more in a seasonal job that runs for just a couple of months, you would still qualify for all 4 quarters for that year, even if you did it in just 2 or 3 months. A perfect example of this is a part-time tax accountant. Most tax accountants work from about January 15th through April 15th, that's 3 months, and let's say that that tax accountant earned $3,000 per month for 3 months. In that scenario, given the limits that we just talked about, even though he or she worked for 3 months, they would qualify for 4 quarterly work credits for the year. This is one that most people don't think about because frankly, hitting those numbers is pretty easy to do. However, where it becomes a problem is if someone has taken an extended period of time off. Usually it happens if they stay home to raise a family and they take 10, 15, 20, 25 years off, for example. In that scenario, it's very possible that you'll miss the 40 quarter minimum that you need to hit in order to qualify for Social Security. I've heard horror stories of people missing it by just 1 or 2 quarters, and they lost out on Social Security simply because they didn't know that they needed to go back to work for half a year to qualify for Social Security. So check with the SSA, look at your earnings history online, and find out how many quarters of earnings you have to your name. That way you'll know what the target is. One final point, and this is really important. The Social Security Trust is due to run out of funds in 2034, 2035, or 2036, depending on which article you read and how it's calculated. It's very likely that the next president will be the one who makes the changes necessary to shore up that trust for the generations ahead. And so if you aren't subscribed to this channel, please make sure you subscribe and turn on notifications so that you get alerted the next time I post a video. We will be covering this very, very intensively over the months and years ahead. If you like this video, check out that video, 8 ways you can lose your Social Security payment, some instantly. This is Jeff Schmidt. Thanks for watching.